Hello?
Hello, is this Ipek?
Yes, this is Ipek.
Ipek, okay. Uh, how are you?
Oh, unfortunately, I do not have a webcam, so I
Oh,
sent a
okay.
picture.
All right. Well, that's a nice picture of you. I'm Dale Pinkard. Very nice to meet you.
Nice to meet you too. Thank you very much.
Congratulations on your FXstreet award, Best New Contributor.
I'm very
So, yeah,
glad.
yeah, you must have made quite an impression because, there are a lot of new contributors every year on FXstreet. So, your work must have really stood out. What can you tell us a little bit about the kind of technical work or fundamental research that you provide on FXstreet, Ipek?
Well, actually, what I like to do is to look at the global picture. So I will always talk about fundamentals, sit what's going
Okay.
on a fundamental picture, and then start talking about technicals. Because technicals is just like a tool that you use in order to feel where are the levels that we could go. What is the fundamental picture that gives that gives the basis for these moves actually. So my best example for that is going to be the Australian dollar, where we were talking about the fact that even if we are picking some positive momentum above 75 cents levels, we would expect some officials to jump in and voice their discomfort about the appreciation in the Aussie, and this is just what happened. So, in this kind of context, I really like to mix up the fundamentals with the technicals so that we have not only a story about trading but also some more justification rather than only numbers. And I think that this is what why people are more interested in what I'm writing, because they can read a story and they can follow up.
Yeah, it's nice to have a narrative that goes along and complements your signals because it gives you a
Yes.
bias, gives you your bias fundamentally, right?
Well, actually, it's not really bias, but you can just like feel and transmit the bias on the market. So in every situation, the market is going to be biased. So the short-term moves are 50-50. It's all about where people see, and it's all about higher information levels. But I think that the global picture has a bias, has always a bias, and this is all about the dynamics and interactions between the central banks and the macro pictures, or even like small deals like on the micro world could impact what's going on in the currency on in a week or in a month. So I believe that this is why it's very important to sit the technicals on a fundamental landscape in order to be more in order to simply being more convinced and be able to convince others.
Okay, you want to do a little time traveling with me, Pick, and get into a time machine and take us back to the beginning of your career and how you got involved in analyzing global markets and what it was like at the beginning of your journey and how you ended up where you are today.
Well, actually, the very beginning of my career has been only with numbers. I have a quant analyst in a little Swiss bank, and I was writing algorithmic certificates. And I thought that it was too much numbers once again, so I missed this landscape, this fundamental picture or the narrative behind it, and I decided to move to portfolio management in HSBC in Geneva. So that was a brilliant job. So you could see all the markets, do portfolios, follow what's going on, where people are interested, and how all these short-term moves are actually triggered, if you will. For example, when I'm talking about a carry trade, I know what I'm talking about because this is something that you would do every night before going home on your portfolios. So I think that this experience in my portfolio management experience has been a positive compared to other analysts of maybe my generation, and it was basically a lucky hand. I met Peter Rosenstreich, who's a very brilliant analyst in Geneva, and he asked me, "Hey, I can see that you got conviction. I can see that you are interested. How about you just become an analyst?" And at that time, I didn't really know what it was about. I was mostly playing with like massive amounts of money, and I thought that being in the information business would be would be interesting actually to be more focused on what's going on in the market rather than just on our portfolios. And this is how I accepted the offer, and has been 4 years that I'm doing this. And I had the opportunity to come to London. I'm just like I'm really not planning to stop here. I will be, moving around, and more you see, more you learn, better picture, more, you have more angles to analyze what's going on. It's just my plan right now.
Yeah, it's an evolving deal, isn't it? And if we're not growing, we're dying. What do you think of
Well,
that?
I think that's a brilliant saying, because I was mostly in Forex, and then I could come to London and see that, there's some more other like micro factors that could impact the what we are looking in Forex. So even in terms of current account or trade balances, you have like incredible stuff going on behind the scene, and it's very important to understand the underlyings that create this moves in the foreign exchange market. So now my intention is to go and travel and see what's going on, because the real economy has absolutely an incredible impact also on what's going on, especially nowadays that the central bank's action just lacks some support from the market and the real economy.
Yeah, what a transition we've made from market participants believe that central bankers were omnipotent and all powerful to seeing now that the emperor has no clothes and central banks have been challenged and unsuccessful and confused. What's your narrative here with what
Well, you're
recently happened with Draghi's actions and then Yellen's actions in the last week?
Well, actually, naturally, we have like some. At least my generation are talking about the fact that, are these actions really worth it? Because it has been 7 years. So first, for a person like me, since I left university, I've never seen the Fed hiking rates except in December. So we have come to this point where over the past 7 years, some massive actions have been taken, and none of them gave results. And the worst thing is that we have seen this economy getting worse and worse. And for example, for the negative raise coming back to Europe and Draghi, I don't think that it's the best deal, simply because I don't think we need a PhD. It's just about looking what's going on in the street. I mean, especially about for Europe, where people are so much on their savings right now because they fear to lose their jobs. Cutting the rates to negative on deposits, I'm not really sure that's going to trigger a consumer activity to enhance this consumer prices up to 2%. So when you look at these when you come back to fundamentals and stop thinking that the economy is something incredible, but bring the economy back in the street, I believe that the central banks are just moving very far away from the reality, and putting all this money in the market just doesn't come into Mr. Smith's pocket. And this is where I think that the divergence between the real economy and the financial markets have gone so far that we can't even think that one day it's going to be flowing back into real market, especially knowing that even for if I was a portfolio manager still right now, or if I'm going to be a portfolio manager, you can be sure that I'm not going to touch the Eurozone bonds, because the risk return ratio are completely hilarious. I mean, 2-year bonds on Spain are paying negative yield. Come on, I don't think that we are just, there are all the reasons out there to lose conviction in central bank action, and I don't know how the credibility issue is going to be managed, so, from now on.
Yes, I can agree with you, Ipek, on the fact that perhaps a man in the street hasn't been helped by central planning, but I will say this in the U.S. that a lot of Mr. Smiths have 401ks, and a lot of them that did not lose their house and still have it have seen a recovery in their 401k and real estate values here in the U.S. Of course, it hasn't filtered down. That's why there's all this anger across the globe and the rise of nationalist type leaders, strongmen, authoritarian type leaders. But for asset prices, it was effective because now people have equity in their homes again, and the S&P was 666, and now we're trading 2050, 2100. So for certain people, it was helpful. Although, if we did not have food stamps here in the U.S., they are invisible breadlines. If people had to stand in line for food, we'd probably have lines stretching from New York City to Los Angeles. So, and also, isn't the purpose of negative rates to tax people on
Well,
their
actually,
savings?
there are
Go
two
ahead.
things. So first, with the US, the situation is somewhat different than the Europe because the US started this quantitative easing and zero rate policy way before. And when the US
Right.
started buying these bonds, sovereign bonds, were well cheap. So in that scenario, so that when the Fed stepped in and started buying sovereign bonds, not only it helped to recover the price, so there was this positive impact, but also, they didn't have that much risk on their portfolio. And at the end of the day, they started unwinding when Euro started. So when we look at the Eurozone and when the ECB decided to start buying these bonds, I believe, or I don't even believe, the bond prices were already too high. The bonds were already overbought, so there wasn't very much of a value issue. So they weren't really readjusting the value in the market. These bonds were already overvalued. So I think that this is what made the base for this distortion that we are seeing today. And we have seen here in hectic market in the Eurozone sovereigns. And at this point, I even believe that with the negative yield, I don't believe that it's going to be helpful for the investors to get into these bonds for for a medium or long term position. So this volatility is, I think, very sad and very dangerous for the Eurozone's economic future and the stability. On the second hand, so negative rates are, of course, they are a signal. They are a very bad signal. Uh, if we are talking about recovery, it's people should be made enthusiastic about spending. People, you cannot get too much people to spend because they fear to lose their savings. So as people fear enough to lose on their savings, they will not be spending. If you're taking my money out of my pocket, I will not go and buy another Chanel bag. I will rather keep more. So this is what we call a liquidity trap, and Japan is known to be fighting with this since the last 2 decades. And there's even academicians that came out with a new theory saying that those are neo-Fischerites. Lower interest rates, if we are especially in negative territories, could enhance deflation rather than generating inflation. And it's all about the ratio between savings and spending. In these countries where savings are a good part of households' budget, I think that putting the rates negative are actually harming or damaging people's purchasing power rather than being a signal only.
Oh, sure. Yeah. Many pensions and savers have been penalized by financial repression with lower rates for a long time and a negative rate where you have to pay the bank to hold your money, even though it's not our money, it's their money once it's in the bank. It's
And
supposedly an attempt to get people, since they're being penalized to save, to go out and spend, and they're getting exactly the opposite reaction. Where do you come down on? It's my view that currency, even if you're a portfolio manager and you're trading other asset classes, that the currency markets are the linchpin for everything else that happens. It spins around it. You have a view on the dollar. Last year, we had a ton of bulls in the dollar. We've been moving sideways in the euro. I know emerging market currencies up until recently have been sinking against the dollar. What's your view on, say, for example, the dollar index? Is this a significant top in the dollar or just a pause to refresh?
well, actually, what we have seen this week is that the Fed now backs up and they're looking for 2 rate hikes only instead of 4 that has been announced. And I'm very skeptical because these 2 rate hikes are contingent on the global economic conditions. And for now, we haven't had any particularly brilliant news of recovery all over the globe. So the dollar index has now came below 95 for the first time since last October. And we were giving the signal of bullish US dollar last year because we were moving towards the first rate hike. And at this point, I believe that we may see some consolidation or even a softer dollar against the G10 peers, but also the emerging market currencies, because the Fed has find itself tied up and it cannot just run alone for policy normalization, because a stronger dollar is at some point going to be negative for the US economy and pull the US dollar and the Fed back into the pool of, the into the into in back to reality. So at this moment, I believe that the negative rate environment or the zero or very low policy rate environment should keep the volatility a bit high for everything that will qualify as emerging market currencies and high yielders, because the investors are still looking to generate return, and even more when the yields are right now very negative. So I believe that this should help the Australian dollar, the Kiwi, but also maybe South African rand, or when the political turmoil is over, maybe the real to breathe a little bit, because these currencies do offer some good interest rate gap and may be interesting for investors looking at not for mid to long term investments, but at least who are who are in a hurry to generate some cash in the short run. If I have an investment to make next week, say a bond is coming up, and I have my euros, I don't want to make let them sleep in a fiduciary account. I would rather go for Australian dollar or Kiwi. So I believe that the negative rate environment will keep the volatility high in high yielders. But even if this is the case, the high yielders as Australian dollar, the Kiwi, or some EM currencies could be well off and benefit from the US dollar weakness that we are looking to that we are looking for developing actually.
A lot of money flowing, Ipek, into the ultimate currency that has survived for eons, gold. And one of the bearish arguments for gold over my career has been opportunity cost of it having no yield. And now that we're moving to get negative yields, it actually is more attractive. Do you look for a continuation of a flight towards the yellow metal in the months and years ahead?
Well, actually, that's quite funny because for your generation, it was opportunity cost. For my generation, it has become mostly the fact that the gold market is now being traded in one click also. So we are moving away from the safe haven view of the gold, and we have seen some serious breakdowns in this negative correlation with risk assets over the past years, especially since the time the gold was testing the $2,000 level. So now I believe that the fact that we are very negative on the environment, and then the idea of having gold, especially in emerging markets, like for example in India, who is looking to have this gold fund, could help to give a little of shine to yellow metal. But nowadays, I believe that the gold has lost a lot of its appeal as safe haven investment, and this is why it is very difficult to say today that the opportunity cost is exactly what's causing this reluctance to get invested in gold. I believe that it is mostly the fact that the negative correlation that we were looking at is not as strong as before, and then this is why the volatilities in the gold market, or the potential of volatility in the gold market, is still keeping the investors a little bit aside in this market when we have some periods of high market volatility.
Well, yeah, actually, the gold really didn't work during the January swoon and the worst start to stock market history this year. in January, and actually they've both been advancing together. The gold showing more relative strength than the S&Ps. So, is it more of a reflation trade than a safety trade?
Well, actually, so this is where there's no safety trade. The safety trades, I think that the new generation is now looking for solid reasons to invest in something they would call safe haven. So I believe that at this point, the blue chips or for example, Swiss francs is still very much up to date. Even if it has lost some value due to negative rates, people are still flying back to Swiss francs. And in 2014, Swiss National Bank had to print 15% more uh, thousand francs actually, as people would like to invest in Swiss francs as if it was gold. So I think that at this point we can just like see as some alternative currencies or alternative markets that investors are chasing after in order to replace the gold, or at least diversify the basket of safe haven currencies that they're looking to buy and keep in order to be safe of these huge market volatilities, like similar to what we have seen on in January actually.
Okay, I'd like the definition. What generation do you label yourself as? A millennial?
I would label myself post subprime crisis generation actually. So post
Okay,
2007-8 generation. It does if
okay,
that does make
and
sense.
besides me being an old man, what do? You put me in the baby boomer generation?
Excuse me?
Besides me being an old man, do you place me in the baby boomer generation?
No,
You're talking.
well, I let you define yourself on that one.
Okay, all right. So, with your bias, if I may use the word, towards the Aussie and Kiwi, um, I would assume, since they're heavily influenced by China, that perhaps you're sanguine on China. If you're attracted by uh, having your money sit in Aussie and Kiwi.
Well, I am very attracted in the question of China, and will be shortly traveling into that country to see what's really going on. From what I know in China is that we are not looking, or the majority of the Western world is not looking at the right fundamentals. For example, we are looking at the consumer price inflation, while when you are in China, you just like rapidly know that you have capital controls in place, and you cannot just withdraw more than a certain amount of money per day, which means that with these capital controls, the inflation levels are kind of biased on the downside. So for me, for example, I would be looking at producer prices, or at the exports, imports, or some other factors that I'll be discovering very happily and very soonly. And I think that Chinese economy has the potential to grow. So now what the PBOC and the Chinese government are trying to do is maybe seen as a little bit restrictive, but we have to know that it's like a 1.5 billion people economy, and some measures should be taken in order to prevent a potential overheating in such a big, massive economy who is craving for growth. I believe that the potential is there. The fact that we have revised the growth forecast to 6.5% is sad for the other for its partners, especially for Australia and Japan, who are actually trying to get on their feet by using China as a support. But China per se is having some difficult time, but has the potential and the resources, the necessary resources in their country, and could very well go against this slowdown in the economy. It is just a matter of how to do it without putting too much pressure or overheating in the market. And it's all about stability. It's not only about growth. It's about stabilized growth. And I hope I will be able to give you more insights when I'll be traveling in that big and very interesting country very soonly, actually.
Yes, and they're trying to make the handoff to a consumer-based economy rather than an export-driven economy. I do have to say their capital controls, I don't know how effective they are because there have been Chinese coming over with suitcases of money buying up U.S. real estate for years, and a lot of flight capital leaving China. Any comment on that?
Well, actually, from my experience, there might be very much capital in China, and the domestic economy. It's a country where the spending will be growing because it's an emerging country and people are looking to own things, so it may be luxury goods or may be like basic needs, but there's so many interests for what is for new things. So this is why actually the international companies are now struggling and fighting back and forth in order to gain more market share into this huge market, and there's so much more to explore. So from my experience, once again, it was very difficult to spend money, even if I wanted to spend and buy things. So there are some there are ways to deviate the capital controls in place, but if you're looking at big majority of the population, I think that these capital controls are still very much waiting on the way that they live, on the way that they spend.
Okay. Speaking of China again, what do you think their geopolitical aspirations are in building up these man-made South China Sea islands and militarizing them? And also their financial moves of starting their own export bank and some other type of monetary transfer system away from, I believe it's what we have here. I forgot what it's called, where people wire money and they're starting up their own system. And do you think that they have a desire down the road to become the reserve currency and replace the dollar as a reserve currency?
Well, to be honest with you, I think that the yuan may one day become a reserve currency regarding the size of that country and how massive the economy is. We were talking about a $10 trillion economy, so now we're a little bit less after the crisis, but there is some, it is massive, so it may become. However, in order to do so, I think that the most important is not the size or what you propose in terms of quality, but mostly of your power of convince people, because being a reserve currency is not coming out and saying, okay, I am a reserve currency. Other countries, so the entire world, should recognize the yuan as a reserve currency. And to do so, I believe that the most important thing is the credibility. If the People's Bank of China are able to have this incredible power on the funds and do not give people the confidence that they could do or they could act as they wanted with this money and when they wanted and in direction they wanted, I think that it will not gather enough momentum or conviction to become so. So the structural reforms are needed, and this black box should have a little bit of, there should be some bright light on this black box in order to start seeing what's going on. And maybe they have a good proposal. Maybe they have something good to propose and to convince people that this is the right way to do, or this is a new model that's going to be a fresh breath on the world economy. But at this point, I don't believe that we are there yet, because the people banks of China has still a very big influence on the market, and this is a very restrictive market. And I don't believe that, I believe that there's some couple of years, maybe we're talking about 5 to 10 years, in order to be at the point where we will be discussing whether yuan could become a reserve currency or not.
Okay. May I ask what your native country is? Where you were
My
born?
name, I am born in Istanbul.
Okay, interesting. So maybe we could switch gears to what's happening in your former native land between Turkey and Russia, and now Russia deciding to leave. And I thought that there might be some type of skirmish before that happened. You never really know. What's your view on what's happening in Turkey, and you trade the lira, and what's your view on the lira?
Well, actually, Turkey is a big question. So Turkey is in the middle of a geopolitical crisis. And we can talk about Russia, we can talk about the Syria crisis, we can talk about
Yeah.
the internal political insecurities and crisis within Turkey also. So this is all adds up together, adds up into a very massive gray cloud. So I wouldn't say it's a black box, but it's becoming somewhat gray. So we have seen the Turkish lira gaining over the past couple of weeks, and now we are testing the 285 level against the US dollar. And this is mostly due to the fact that the emerging market currencies are better bid because they offer higher yield. So now in Turkey, what we are expecting. So next week we have the decision of Turkish Central Bank, and this is going to be the last meeting of the current governor Başçı, and he has been under huge pressure actually in order to keep the monetary policy loose and keep the rates at low levels, at I mean, the lowest he could, because this is the way that the government was asking or looking at, putting some more money in the system and sustain the economic growth. Um, so now this is going to be the last meeting, and after that we see a change in MPC. So this is very interesting because now the Turkish lira analysts are asking for a simplification in Turkish policy since months now, because nobody is in a position to understand very well what Başçı was trying to do. We have an upper corridor, we have a lower corridor, we have a benchmark rate, we have an average funding rate that the analysts are right now looking at. So it has been a while that everybody's asking for the simplification. And I believe that with the new MPC, I believe and I hope that with the new MPC, we will have this simplification so that we can compare what's going on in Turkish lira, what's the worth, what's the rate, what's the actual real and nominal rate, so that we can compare the Turkish lira internationally to the ZAR, to Brazilian real, or other currencies that are offering similar, say, risk and return ratios. So I
Well,
believe that.
okay. Well, I
So I
hope they
believe
do
that
simplify their currency situation because the geo situation of them being adversarial with the Kurds and them being our ally in NATO and yet us being supportive of the Kurds is really a mess, isn't it?
Well, actually, I'm not really keen on making political comments. It's a very difficult
Okay.
situation for Turkey to be in, because the Syrian crisis is just very overwhelming for people in Turkey,
Yeah.
but also for the whole Europe, and also for Syrians themselves who are fleeing their country
Yeah.
because they are desperate and they've got nothing to do. So I believe that the way that the political situation is evolving, or all these the deals or the negotiations on people's lives, I think it's rather very disappointing and very sad. So I really believe that I wouldn't like to, put a price on that crisis.
Yes. Well, all we could do is hope.
Exactly.
So it was a pleasure meeting you. Ipek, and I could tell now after talking to you for about 20 minutes why people want to read your writings and keep in touch with your views. What's the best way to do it? I have your Twitter handle is the same as your name. Are there other ways for people to follow you? Where can they find you on FXstreet or anywhere else?
Well, exactly. So I'll be like always on Ipek Ozkardeskaya if they want to follow me, and just like come and talk to me. It will be just with pleasure. I love doing this as my job, so do not hesitate.
Okay. Well, congratulations again. It's a pleasure meeting you, and you now have a new follower, and his name is Dale Pinkert. I'm going to be following your writings. I found your views to be refreshing. Good luck being a globetrotter. Enjoy. You're living the life, Epec.
Well,
So
exactly. I'm trying to. Well, it was a
you're
pleasure
you're,
talking to you.
you're living the dream, Epec. So congratulations on having your dreams manifest and living them.
Well, thank you very much. It was a pleasure talking to you. Have a